If you invest in a business by buying shares, you become a shareholder. Shareholders are normally entitled to a share certificate. What are the benefits? Well, shareholders are entitled to a dividend. These are paid from net profit after tax. Imagine a company has profit before tax of 10,000, tax of 2,000, and net profit after tax of 8,000. It can choose to pay the entire 8,000 as dividend or pay part of the net profit after tax as dividend. If the company pays £2,000 as dividend, it implies a payout ratio of 25%. That is 2,000 divided by 8,000. The payout ratio is therefore dividend divided by net profit after tax. But wait a minute, why would shareholders accept only 25% as payout ratio? Well, this means that the business retains or reinvests 75% of the profits back in the business. The reinvested funds will generate further profits in the future, and ultimately the shareholders will benefit as more profits mean more dividends. My name is Shakti Ramtaho, and I'm a lecturer in accounting and finance.